We're heading toward the most acute shortages of energy since World War II.
Motorists who began lining up before dawn in hopes of getting enough gasoline to take them through the day.
Are you mad about the way prices have risen in food?
Thoroughly discouraged and disgusted with the whole thing.
There was a general sense of concern that something had gone wrong in the American economy.
So the stock market will crash. It's happened time and time again. This is the scary truth. However, it doesn't have to be a bad thing. As long as you're properly prepared, you can benefit from the chaos. By understanding these strategies, you can spot the warning signs of a crash and use them to your advantage. So how common is a market crash? Well, there are 3 different types of market decline. First is the most common type of decline, a market correction. This is defined as at least a 10% drop from a recent high. These can be caused by various factors, but think of it as the stock market realizing it's getting a bit expensive and cutting back prices. On average, these have happened around every 1.2 years since 1980. The second most common type of decline is a bear market. Now, you know when you're in a bear market, when prices have dropped more than 20% since 1932, these bear markets have popped up on average every 4 years in 8 months. They tend to keep dragging the market down for about 289 days, or roughly 9.6 months. Sure, that sounds like a long time, but keep in mind that prices have dropped.
I've always wondered myself, why do we have to hear this every night, what the stock market is doing?
70 record closing highs so far for the Dow.
Blasting through a ceiling.
In a record-setting IPO.
Investors who have been riding the wave.
As the stock market goes, so goes the wealth and the health of the American economy.
What the market is telling us is that we are on the road to prosperity.
In the skyrocketing stock market, and that benefits everyone.
The stock market has gained almost $3 trillion in value since the election.
Bull markets, which is when the market is going up, usually last around 965 days or 2.6 years. The third type is a stock market collapse, which I class as an over 30% drop in the stock market, normally within a very short amount of time. Although these are very uncommon, they can happen. In my opinion, if Trump had been unalived, then this could have been a very real scenario. That isn't a political view, just a logical one due to the way the stock market reacts to this kind of thing. The main takeaway from all of this is that if you aren't ready for the stock market to go down sometimes, then you shouldn't be investing in stocks.
Stock markets give people a chance to decide which companies deserve to succeed, which ideas are worth a gamble.
There's something about giving people games to play. You look at successful countries and they all have stock markets. And countries that tried to shut them down are coming around and instituting them now.
Well, let's discuss the 3 phases of a market crash so you'll know what to look out. I'll also share the strategies I use at each stage, backed by real-life examples from my experience. This way, you'll be better prepared than most investors. Remember, I'm not a financial advisor, and this isn't financial advice. I'm just sharing what's worked for me over the years. Number 1, the euphoria phase. This is the stage where the market is at its peak and irrational excitement drives prices to unsustainable levels. During this stage, everyone is happy and flying high. When I start seeing this blind happiness, I prepare my investments for when everything comes crashing back to reality. Before the 2008 financial crisis, there was a couple of things that I noticed that really made me cautious about investing. First was the booming consumer spending. Everyone had money, they were spending thousands, and the economy was thriving. A more recent example of this is the NFT craze. A couple of years ago, never in a million years would I have thought that people would buy JPEG image files for millions of dollars. Things like this are a clear sign of it. The second thing I noticed in 2008 was the increase in the number of people buying houses or refinancing. This is because it was easier than ever to get credit as the housing market was booming, which meant if people were unable to pay their mortgages, then the banks could take back the properties without losing any money. Now, it's one thing noticing these little clues, but it's another thing actually taking action and preparing yourself. Between 2007 and 2008, I could have just gone along with the crowd, as the general herd mentality was that everything was great and nothing would ever go wrong, but instead I started to prepare my investments for the worst. At the time, lots of my friends and fellow business owners didn't quite understand the decisions I was making. They may have even seen me as an idiot. a bit of a coward, but from my perspective, I don't think they understood how much risk they were taking. So if your spidey senses start tinkling, these are some of the things you can do to prepare yourself for the worst. First, I would evaluate and minimize your risk level where, personally, I'm not focused on chasing crazy high returns, as that's unsustainable for the long term. I just want to be making reasonable gains consistently so my money compounds. Secondly, I would start to reduce my leverage. Now, on one hand, leverage is a great way to accelerate wealth, but it can also be very dangerous. The thing is, if a stock crashed too far, then your investing platform may issue a margin call, which means you have a limited amount of time to pay off your debts. And if you don't get brokerage, may sell your stocks at the bottom of the market to recover the money you borrowed. If this is something you're considering or even doing, then if I were you, I would be paying some of this debt off. I never use margin, but that's a personal choice. And I'm well aware that by not taking on this risk, I'm missing out on some potential profits. The truth is, I've seen too many of my friends go from millionaire status to broke in a blink of an eye. And now I just stay well clear of it. Thirdly, I'd start saving some extra cash in a high-interest savings account. I know I bang on about having an emergency fund of 3 to 5 months of your living expenses, but I'm talking about saving even more. I did this between 2007 and 2008. From the outside, it looked a bit strange. The market was booming, and by leaving my money in the bank, I wasn't taking advantage of it. However, I noticed that more and more people were getting interested in investing, which tipped me off that there was a bit of a bubble forming. You see, when everyone starts getting comfortable with the idea of investing, it can be a sign that things are about to pop, as pricing is being propped up by inexperienced investors. The trouble is that at the first sign of a crash, lots of these people panic sell, which drives the prices down even further, leading to a spiral of doom. Finally, in this stage, I would make sure my investments were properly spread out. This is called diversification, and it's one of the best ways to help withstand a market crash. As quite simply put, you haven't got all your eggs in one basket. This is all because you never know what sector is going to be hit the hardest. During the good times, it can be very common for people to do very well with 1 or 2 stocks and end up with most of their money, a couple of different companies. Even if they start out with lots of different stocks, it can almost seem silly to put your money into other things when one stock outperforms all your others. Look, nobody can predict if the stock market's going to go up or continue downwards. However, diversifying goes some way to reducing your risk. Yes, you can't guarantee returns, but at least you're investing in a broad range of sectors. Another great way to diversify while guaranteeing a return on investment is through something called a high-yield cash account. As the more assets you can invest in, the better you'll probably end up doing in the next phase. The bottom line here is that while some choose to panic sell and lose all their money, others choose to double down and buy the dip, which if done correctly can make you a fortune. I feel like I should also mention that some investors like to short stocks, which is basically betting that a stock will go down. In this final phase, the market begins to recover and rebuild, rising from the ashes of the crash. It usually pushes above and beyond the last market highs. I noticed that 4 years after the 2008 crisis happened, just after the London Olympics, things started to improve. Businesses were hiring, and money was a bit easier to come by. But even though people started to have cash again, the mentality of not spending carried through for a while. So it was another 4 years really until everything was back to normal. I've experienced a lot of crashes. I'm talking Black Monday, the dot-com bubble, the 2008 financial crisis, and the 2020 pandemic. If you want me to walk you through exactly how to start investing in the stock market, make sure to subscribe if you want to grow your wealth. Okay, I'll see you over there.